Welcome to Lumen Publicum, an investigative journalism news website covering power, money, and public accountability across Europe. I'm Daniel Palmer. If you want the full report behind this episode, with sources, court records, registry notices, and parliamentary material, visit lumenpublicum.org. And before we get into it, please like, share, and subscribe. It really helps people find this work. This story is often remembered as the death of one banker, Roberto Calvi, under Blackfriars Bridge in London on the 18th of June, 1982. But the documents say that was not the whole event. Not even close. Banco Ambrosiano's collapse was not simply a bank going bust after bad decisions. It was, according to the forensic record, the failure of a transnational structure built to move money across borders, blur related party exposure, and sit in the cracks between regulators. 4 days before Calvi's body was found, on the 14th of June, the Bank of Italy opened an investigation. The central estimate was staggering. Questionable foreign loans of roughly 1.9 to 2.2 trillion lira, around 1.4 to 1.6 billion US dollars in contemporary terms. Different sources phrase it a little differently. Unaccounted for, a hole in foreign exposures, missing funds, but the order of magnitude is stable. There was a vast gap, and it sat not at the neat center of one domestic balance sheet, but in foreign channels. That matters because it changes the frame. If this were only a classic insolvency, you'd ask whether one bank made reckless loans and ran out of capital. Here, the harder question is, what kind of group had been assembled, through what entities, and why did so much of its real risk live offshore or in affiliates whose obligations were hard to consolidate cleanly? By June 1982, the crisis was already international. Contemporary reporting and later legal proceedings show that hundreds of institutions had exposure through interbank lending and syndicated credit. The default of the Luxembourg holding company was highlighted abroad. The Bahamas arm soon ran into formal trouble. U.S. courts would later handle turnover orders tied to Bahamian liquidation. Ireland would become a venue for civil fraud and tracing claims. Luxembourg had its own controlled management route. So from the start, this was less a single collapse than a chain reaction with different legal fragments in different places. And Calvi's death, dramatic as it was, also did something practical. It removed the central decision-maker at the exact moment markets, supervisors, and creditors were trying to work out who controlled what, who owed what, and, this is the key point, who was supposed to stand behind offshore promises that had been sold as credible because they carried the Ambrosiano name. So in this episode, we're going to stay close to the record. The legal files, the timeline, the offshore architecture, the supervisory failures, and the questions that remain unresolved. No myth-making, no tidy conspiracy board, just the documented anatomy of a collapse that was never merely a bank failure. To understand Banco Ambrosiano, you have to start with structure. And structure, in cases like this, is never decorative. It is operational. The key hub was Banco Ambrosiano Holding S.A. in Luxembourg, originally formed in 1963. Contemporary reporting and later registry material describe it as the coordinating vehicle for the group's international participations and fundraising outside tighter Italian banking constraints. That phrase matters. Outside tighter Italian constraints. The holding company was not simply an address on paper. It created a point from which the group could assemble foreign interests, raise funds, and present itself as diversified, while also placing crucial activity beyond the reach of any one domestic supervisor. Where was I going with this? Oh, right. The group looked bigger and more international, but also harder to see as a single risk organism. An Irish civil record, later used in cross-border asset tracing litigation, gives one of the clearest maps. It says the group was chiefly controlled through two vehicles, Banco Ambrosiano Holding in Luxembourg and La Centrale Finanziaria Generale in Milan. Under the Luxembourg arm sat controlling interests in Banca del Gottardo in Lugano, Banco Ambrosiano Andino, first in Lima, later linked to Luxembourg, Banco Ambrosiano Overseas Limited in Nassau, and other institutions including Ultrafin International Corporation in New York. Under La Centrale, sat Italian interests including Credito Varazzino, Banco Cattolica del Veneto, and Toro Assicurazioni. Now on paper, that can resemble geographic spread. Switzerland, the Bahamas, Peru, Luxembourg, the United States, plus domestic Italian entities. Diversification, maybe. But the same legal record points in the opposite direction. It attributes remarkable executive concentration to Roberto Calvi, who held multiple chair and director roles across the parent, the holding company, the Bahamas Bank, the U.S.-linked finance company, and other control vehicles. Despite a large board, the court record suggests he had something close to a free hand. That is a red flag in any newsroom notebook. A group that appears dispersed can in fact be tightly centralized if one executive drives decisions across the nodes. So the risk was not truly spread. It was concentrated in governance, in information, and in opaque affiliates whose intercompany relationships were not easy for outsiders to reconstruct. And there's another subtle but important point. In many sources, Banco Ambrosiano International is less a strict corporate name than a functional layer. The Luxembourg Holding Company, the offshore banks, and the finance entities acting together as a machinery for cross-border deposits, credit extension, share support, and transfers. That functional layer is what supervisors struggled to pin down. Was it one group in economic reality? Yes, arguably. Was it one group in legal and prudential control? Not neatly. That mismatch, economic integration, legal fragmentation, runs through the whole scandal. So how did the system work? The core mechanics, based on the inquiry material and litigation records, look like this. Related party lending, offshore shell companies, circular transfers, and liabilities shifted beyond transparent consolidation. Not every transaction is publicly reconstructed in full, but the pattern repeats often enough to be legible. Start with related party exposure. The Irish proceedings list several companies said to be directly or indirectly controlled by the Vatican-linked institute. Manic in Luxembourg, Aron, Bellatrix, Belrosa, Starfield, and UTC United Trading Corporation in Panama. That same record says loans were frequently granted to these companies by group members, especially Banco Ambrosiano and Dino. If true, and this is litigation-grade material, so we use it carefully, that suggests credit moving to entities linked by control or influence, rather than to plainly independent borrowers. Then add the offshore shells. Once you route lending through entities in Panama, Nassau, Luxembourg, or similar nodes, you gain distance. Distance from the parent balance sheet, distance from easy supervisory review, and distance from anyone trying later to identify beneficial owners. Nominee holdings and fiduciary intermediaries deepen that fog. The Anselmi inquiry describes share packages held through intermediaries with plainly fiduciary functions, and even the destruction of certificates that could have preserved ownership trails during recapitalization operations. That's not clerical sloppiness. That's evidence becoming harder to trace. Letters of comfort or patronage were another crucial device. These are not always clean, on-balance sheet guarantees. They can operate more like soft assurances, signals to lenders that a borrower has backing from a stronger sponsor. Economically, they reassure. Legally, they can remain contestable. And that gap is exactly what makes them useful in an opaque structure. Lenders may behave as if support exists. The balance sheet may not recognize a firm guarantee in the same way. So imagine the effect. A third-party bank lends to an offshore affiliate or shell because the Ambrosiano name or a comfort-type assurance suggests the group stands behind it. Meanwhile, the real obligation may sit in an entity not fully or transparently consolidated, or in a jurisdiction where enforcement becomes messy. That's a terrible analogy. Let me try again. The group could project one credit story outward while internally distributing the liabilities into compartments. We even get glimpses of specific transaction footprints. One civil tracing context describes funds allegedly moving from a Banco Ambrosiano and Dino account at Banco Ambrosiano overseas in Nassau, and later appearing in Dublin under the name Arborfield Limited. U.S. court records show that the Bahamas Bank had clearing, custodial, and brokerage accounts in New York, and that U.S. courts later froze assets and ordered turnover to Bahamian liquidators, with some set-off disputes left for later determination. Put all that together and the picture is not random chaos. It is choreography. Money moved through affiliates that were economically close, legally separated, and evidentially obscured. The Banco Ambrosiano story does not sit in a sterile banking file. It sits in a wider environment where finance, politics, judicial pressure, media influence, and Vatican-linked relationships overlapped. That doesn't mean every allegation became a proved fact. It does mean the official and legal records repeatedly point to networks that went beyond ordinary banking governance. The Ambrosiano-IOR relationship is central here. The Irish litigation record says the Vatican-linked institute was among the largest shareholders of the Italian parent and a substantial shareholder in the Bahamas entity. It also lists companies allegedly controlled directly or indirectly by that institute and says those companies repeatedly received credit through group affiliates, particularly Banco Ambrosiano Andino. That is important because it frames the Vatican nexus not just as reputational proximity, but as a possible channel of recurring offshore credit. Now, there were legal and public consequences. Major reporting later noted that Archbishop Paul Marcinkus was charged as an accessory to a bankruptcy found fraudulent, though never arrested, and that the Vatican made a payment to creditors described as a goodwill settlement, while denying legal or moral blame. Sources vary on the precise amount, and the report is careful about that. The point is not to overstate certainty. The point is that a settlement existed. The denial of liability remained, and the credit relationships around Vatican-linked companies were serious enough to become a lasting part of the record. Then there is P2, the Propaganda Due milieu. Parliamentary inquiry material chaired by Tina Anselmi describes a broader environment in which judicial problems were managed, influence was exerted, and ownership structures were concealed. The inquiry goes beyond banking in the narrow sense. It touches publishing, newspaper control, share custody, and the use of fiduciary intermediaries in the Ambrosiano-IOR orbit. One striking example concerns financing tied to Rizzoli Editore and the Corriere della Sera operation. The Anselmi material describes 22.5 billion lira in financing, plus share transfers and custody arrangements designed to obscure who really held what. It even refers to the destruction of trace-bearing certificates. If you're an investigator, that is the moment you stop thinking in siloed categories. This is not only banking malpractice, it is ownership control and information management being financed through opaque credit channels. And P2 matters because it supplied context for why certain exposures may have been protected, delayed, or kept from clean disclosure. The inquiry describes efforts to sistemare le pendenze giudiziarie, to sort out pending judicial problems. That suggests the concealment mechanisms were not merely technical. They may have been socially and politically defended. So when people say Ambrosiano was a Vatican scandal, or a P2 scandal, or a banking scandal, the honest answer is, it was all of those, intersecting. The records show overlap. What they do not give us is a single final ledger explaining every motive and every beneficiary. The collapse phase in 1982 moved fast. On the 14th of June, the Bank of Italy opened its investigation into the questionable foreign loans. On the 18th, Calvi was found dead in London. In June, commissioners were appointed to administer the Italian bank, while the default of the Luxembourg holding company was being noted internationally. On the 7th of July, the central bank provided a first fixed-term advance of 97 billion lira for 22 days. Emergency liquidity support, not a cure for the deeper hole. Then, on the 16th of July, Bahamas authorities suspended the banking license of Banco Ambrosiano Overseas Limited. That is a critical offshore failure point. It pushed the Nassau entity into liquidation procedures that would later be recognized in the United States. On the 29th of July, in Luxembourg, Banco Ambrosiano Holding was placed into gestion contrôlée, controlled management. Different jurisdictions, different legal tools, same collapsing system. By the 6th of August, Italy's Treasury Minister announced compulsory administrative liquidation for the Italian entity. 2 days later, on the 8th of August, the successor institution Nuovo Banco Ambrosiano was created, with central bank debt then reported at 143.5 billion lira. So the Italian state and supervisory apparatus were effectively drawing a boundary, The old bank would be liquidated. A successor would carry on viable operations. But the wreckage did not resolve in one courtroom or one proceeding. This is where the legal fragmentation really shows. In the Bahamas, BAOL moved through liquidation under court supervision. In the United States, the Matter of Culmer ancillary case granted comity to that Bahamian liquidation, enjoined creditor actions, and ordered turnover of U.S.-located assets while reserving specific set-off questions. In Ireland, civil proceedings around tracing and alleged fraud built out a detailed factual map of the group and produced findings of fraud on the balance of probabilities. In Luxembourg, official registry notices track the holding company's controlled management, the 1984 liquidation plan, judicial approvals, and the appointment of liquidators. That means no single proceeding explained the whole machine. Some cases were about asset recovery. Some were about insolvency administration. Some about criminal liability. Some about specific transaction chains. Even years later, Luxembourg registry notices still marked Banco Ambrosiano Holding and Banco Ambrosiano Andino as in liquidation. And the murder case? In Rome, the later trial ended in acquittals, because the court found evidentiary weaknesses, despite the broader acceptance in that framing that Calvi had been murdered rather than having died by suicide. So even at the symbolic center of the story, the legal endpoint remained incomplete. Fraud findings existed in some places, recoveries happened in some places, but no final, unified proceeding ever told the whole truth of the whole system. If there is one lesson that survives all the personalities, all the headlines, and all the mythology, it is this. Banco Ambrosiano exposed a mismatch between integrated financial groups and jurisdiction-bound supervision. The group operated like one organism when raising funds, moving risk, and projecting credibility. But when scrutiny arrived, it broke apart into holding companies, banks, shells, affiliates, and legal compartments across Italy, Luxembourg, the Bahamas, Switzerland, Ireland, and the United States. The Bank of England noted the international market effects and the default of the Luxembourg holding company. Parliamentary debate in Italy later asked why concerns visible as early as 1977 or 1978 did not trigger decisive containment. That's not ancient history in any comforting sense. Europe still wrestles with versions of the same problems: holding company opacity, risk migrated offshore, politically protected credit, and institutions that appear consolidated in market perception, but fragmented in supervisory reach. And there's a deeper caution here. Banking scandals are often narrated as moral dramas about one villain or one fatal week. But the documents on Ambrosiano show something colder. A structure can be designed so that accountability decays with distance. Ownership becomes obscured through nominees and fiduciaries. Guarantees become moral rather than clearly legal. Credit flows to related entities through offshore affiliates. Supervisors see warning signs, but no one authority sees or stops the full picture in time. Several questions remain materially open. Who were the ultimate beneficial owners behind all the offshore shells and nominee share packages? Can the full ledger of transfers across Luxembourg, Nassau, Peru, or Luxembourg, Switzerland, and US-linked entities ever be reconstructed? Which creditors relied on which comfort letters, and how were those assurances presented internally? Were earlier supervisory interventions blocked by legal limits, political pressure, or simple evidentiary weakness? And, hanging over all of it, did the missing funds connect to specific third-party pools that were never fully exposed in court? That's why Banco Ambrosiano still matters. Not because it is mysterious, though parts of it remain unresolved. It matters because the core failure is legible, documented, and familiar. Cross-border finance outgrew cross-border oversight, and opacity became a business tool. If you found this useful, please like, share, and subscribe. And for the full report, including the underlying legal records, parliamentary inquiry material, registry notices, and source list, visit Lumen Publicum at https://lumenpublicum.org. I'm Daniel Palmer. We'll keep following the paper trail.